AeroVironment. The crash you are waiting for already happened. And you did not buy then either. This is a stock that sits in a peculiar kind of purgatory. Everyone admires it. Very few own enough of it. The pitch. The case writes itself. Purist play on tactical drone warfare, combat proven in Ukraine, protected from Chinese competition, program of record status with the United States Army. And yet, at $230 per share and 50 times trailing earnings, the plan becomes elegant. Acknowledge quality. Admire from afar. Back up the truck when a crash delivers a 30 or 40% haircut. Here is the problem. That crash already happened. It was called 2022. AeroVironment fell 35% while fundamentals improved. If you did not buy when headlines screamed recession and defense stocks sold off with everything else, what makes you confident you will buy during the next panic? The same psychological barriers preventing you from buying at 50 times today will prevent you from buying at 35 times when the world feels like it is ending. The valuation problem that is not. 50 times forward earnings sounds priced for perfection, except that framing uses the wrong denominator. Backlog exceeds $830 million. Management guides 17 to 20% organic revenue growth through fiscal 2026. The $990 million Switchblade contract provides visibility tactical drone companies simply did not have 2 years ago. Run the numbers forward. At fiscal 2027, earnings of $850 to $950 per share, the stock trades at 24 to 27 times. For protected supply chains and infrastructure level importance to NATO drone doctrine, that is reasonable. Not cheap, but not the nosebleed the headline suggests. The market is using trailing metrics to value a company whose forward visibility has fundamentally transformed. Now, the part they do not tell you. Bulls talk about Switchblade effectiveness. Theirs talk about prime contractor competition. Both are focused on hardware. Wrong lens. The durable moat is that AeroVironment is becoming the training and procedures integrator for NATO small drone warfare. Every certification, every deployment, every mission creates institutional muscle memory nearly impossible to displace. When a 22-year-old infantry sergeant learns drone warfare on Switchblade, she carries that mental model for her entire career. She trains subordinates on these systems. She writes doctrine assuming these capabilities. By 2027, the company could have 50,000 trained operators across allied forces. The consumables and support revenue from that installed base alone could justify 40% of current market cap. New hardware becomes gravy on an annuity. Why 2022 does not repeat. The stock entered 2022 at 70 times earnings on speculative euphoria with zero contract visibility. The sell-off was multiple normalization from absurd levels, not fundamental derating. Today, the setup is inverted. 50 times trailing, but roughly 25 times on fiscal 2027 estimates, with program of record backlog. Replicating 2022 requires the stock to first spike to 70 times, then crash. That is not a crash. That is a round trip through a bubble that does not exist. What could actually break? 2 risks deserve weight. Supply chain constraints. Scaling from hundreds to thousands of units requires proportional scaling of single-source components. A supplier failure could delay $200 million in revenue. Ukraine fatigue. The past 2 years benefited from roughly $500 million in supplemental funding. If that shrinks, it creates a 15 to 20% revenue headwind. These argue for scaling in rather than going all in immediately. The asymmetry. Bull case. Switchblade achieves standard NATO status. Counter-drone scales. Acquisition premium materializes. Roughly 60% upside. Base case. Management hits guidance. Operating leverage materializes. Modest positive returns. Bear case. Funding dries up. Supply chain constrains scaling. Roughly 35% downside. More upside than downside, but the bear case is real enough that sizing matters. The position. Start small. Double if August guidance confirms the trajectory. At $180 or below, move to full position. The $140 level some investors want probably requires a recession severe enough you will not buy anyway. Everyone agrees this is highest quality. Everyone waits for a better price. That price probably is not coming unless fundamentals deteriorate, at which point the quality thesis weakens anyway. Sometimes the opportunity cost of waiting exceeds the benefit of a slightly lower entry.